Hello everybody, today I'm going to be turning £100 into significantly more, and by today I mean over the course of a while, but we're going to learn to trade. Now, I have very minimal prior experience with regards to trading, and I'm looking to learn. Firstly, I'm going to want to learn about the things that I know I don't know about, so things like resistance. It seems like a very simple basic concept within trading, but it's something that I know very little about. We've got ChatGPT up, GPT-4, because nothing but the best. We're going to be basically just asking questions and trying to get to the sort of responses out of it that we'd want from like a Wall Street investor, then giving like advice based on the best knowledge that they have. So I'm going to start off by saying I'm interested in starting to invest on the stock market. I'll be using Trading 212, so I'm going to say using Trading 212. What sorts of things do I need to know? If I could type, that would be helpful. Let's see what it says. So, starting to invest in the stock market. Let me zoom in here a bit. Right, starting to invest in the stock market is a significant step, and it's great to see that you want to educate yourself before beginning. Trading 212 is one of the platforms you can use to invest in the stock market. Before you start investing, here are some of the things you need to know. 1. Understand the platform. Familiarise yourself with the user interface of Trading 212. Learn how to navigate through different sections and understand functionalities, fees and charges. Understand the fee structure. It's essential to be aware of any commission spreads and potential other charges that might apply. Or other potential research tools. Learn how to use various research tools available on the platform. These tools can help you analyze stocks and make more informed decisions. Demo account. Consider using a demo account. So I'm not going to be using a demo account because of 2 reasons. Number 1, I've done that, and I will get a screenshot up for you just now, which can demonstrate that I turned 50k into at least 3.5 million. If I use a demo account, I'm more likely to make risky trades that I'm not capable of actually reasoning as to why I'm doing it. And although I can come up with some reasoning after I've made the profit, it's like anyone could do that. That's not me learning and applying the knowledge. That's just me going, frick it, it's not real money, let's just spend it, sort of thing. And that's what I did. I think I made 1.6 million on Tesla and oil. No, just one trade, 1.6 million from a 50k investment or something over the COVID sort of period. So I'm not going to be using a practice account. I'm just going to be starting with £100, and we're going to turn that into significantly more, hopefully. So, fundamental analysis. Learn to read and analyze financial statements of companies, including balance sheets, income statements, and cash flow statements. Now, that's going to be an interesting thing for me anyway, because I'm interested in business. It's interesting for me to see what sort of things the companies are doing. Ratios. Understand the key financial ratios such as price to earnings, price to book, debt to equity, etc. to evaluate a company's financial health. Okay, so what I'm thinking, can you help me understand the importance of P to E, P to B, and debt to equity, and any other factors I may need to understand with regards to how they are going to impact the price of a stock. Right. Let's see. So, understanding financial metrics and ratios such as price to earnings, P/B, and debt to equity ratio can be incredibly helpful in analysing and selecting these stocks for investment. Let's break down each of these metrics and discuss a few other critical factors that can impact the price of a stock. So, market value per share over earnings per share. Important. Valuation. It helps in assessing whether a stock is overvalued or undervalued. A high P to E ratio could indicate overvaluation, while a low P to E might indicate undervaluation, although the context matters greatly. Companies with high growth prospects often have higher P to E ratios. Impact on stock price. A company with a high P to E might have high expectations built into its price, and any disappointment can lead to a price decline. Okay, so a high P to E ratio means one of 2 things. Could be overvalued, or they could have a plan for what's going to happen in the future, and therefore, because the investors foresee profits in the future, the price is going to go up. That's my understanding of it so far. price to book ratio, market price per share over book value per share. What is book value? Ratio of a firm's common equity divided by its number of shares outstanding. Okay. What is common equity? This is probably all really simple stuff that everyone knows, but I don't, so I've got to research it because I need to make sure that I'm not losing myself money, because that would not be good. So, common equity is the amount that all common shareholders have invested in the company. Most importantly, this includes the value of common shares themselves. However, it also includes retained earnings and additional paid income. Okay, so common equity is the amount that all the shareholders have. So if a company called X, oh wait, no, that's the thing now, if a company called Y were to have 100% of their shares, and then they would say, right, okay, we're going to allow 10% of our shares to, we're going to open them up to the stock market, let shareholders or potential investors buy our shares, then all 10% of those shares are bought at a certain amount, then it's the certain amount times the amount of shares there are that formulates the common equity. So it's just commonly owned equity in the company, I guess. So book value per share takes the ratio of a firm's common equity divided by its number of shares outstanding. So what is a number of outstanding shares? Because I don't understand the wording of that. Okay, so that makes sense then. So this is the amount of shares that aren't bought. So in the example I gave where Y allocates 10% of their company that could, they say this can be bought. Basically, you've got that same concept, but if only 7% of the shares are bought, then there's 3% that's outstanding shares because they haven't been bought. So total number. So issued and actively held by stockholders. Let's ask ChatGPT, it might give me a better explanation. What does the number of outstanding shares indicate? Is that a worthwhile question to be asking? Right, the number of outstanding shares refers to all the shares the company that are held by all of its shareholding. Okay, so including share blocks held by institutional investors and restricted shares owned by the company's insiders. Here's what the number of outstanding shares can indicate and why it's important. Market capitalization. The number of outstanding shares is used to calculate a company's market capitalization, which is critical. There's a lot of big words. I've just looked at that and not understood a word. Okay. The number of outstanding shares is used to calculate a company's market capitalization, which is a critical measure of a company's size and value. Okay, so market capitalization, a measure of the company's size and value. The number of owned shares, so outstanding just means owned. I'm going to put that in my little notes. So outstanding means owned. Simplifying things for myself because I'm not particularly smart. And current market price per share, so that's just what it's listed as, or listed out in the market, I would presume. And I don't think that's an obscure presumption to make. So earnings per share, the number of outstanding shares is used in the calculation of earnings per share, a crucial metric. Okay, so this makes sense. So before I read this, I'm presuming the amount of shares owned, the percentage increase times by the amount of shares at the price that it was at. I can't explain it, but this does. Number of outstanding shares is used in the calculation of earnings per share, a crucial metric in financial analysis to understand the company's profitability. The formula is net income minus dividends on preferred stock over number of outstanding shares. Okay, so yeah, that's exactly what I was trying to explain, but in proper terms rather than idiot terms. So stock splits. Companies can sometimes increase the number of outstanding shares through stock splits and make the shares more affordable. So for example, you double the amount of shares but half the price of each of them, and then anyone who owns one share then owns two shares, each at half the price of their original one share combined. So, no one loses out, no one gains, but they've got more stocks that can be bought. So what's the purpose of this? So companies sometimes increase the number of outstanding shares through stock splits to make the shares more affordable or to increase liquidity. Okay, that stands to reason. It doesn't change the total market capitalization. Yeah, that makes sense. Buybacks. Companies can reduce the number of outstanding shares by buying back shares which might increase the stock price and EPS. Basis for financial ratios. Apart from earnings per share, the number of outstanding shares is used as a denominator in various other financial ratios and metrics, helping analysts and investors to understand and compare companies better. Impact on stock price. An increase in the number of outstanding shares can potentially put downward pressure on the stock price. Okay, while a decrease can potentially have the opposite effect, all other things being equal. Right. Understanding the number of outstanding shares and how it changes over time can provide important insights into a company's financial condition and its approach to shareholder value creation. It's a vital metric that investors should pay attention to while analysing a stock or investment. Okay, brilliant. So I would say I understand outstanding shares now. They're the amount of owned shares, essentially. As I said in my little document here, outstanding means owned. Probably could have saved myself some time on reading all of that. Bye!